Okay, so our second important thing to consider when purchasing a rental property is appreciation and taxes. So, in the first section with understanding the spread, we talked about how your positive spread is something that, we strongly recommend that you let that build up in a bank account so that you can then use it to help offset unexpected costs of repairs or other things. That once you feel pretty comfortable that you have enough cash built up to protect yourself there, that's the first area where you can start to get a positive return on your investment by taking that money and using it for other things in your life. So another way that you're going to get money back on your investment is through appreciation. When I say another way you're going to get it back, it's if you have a positive appreciation, which is what we're shooting for. So appreciation really is how the value of a house changes over time. It's it'll be partially driven by the house itself and that you keep it maintained and in good quality, but it's also very, very driven by neighborhoods. Certain neighborhoods become on trend because either they opened up new shops or restaurants that make the neighborhood more appealing. Maybe it's got really good school ratings, or conversely, you can depreciate or have negative appreciation if, let's say, crime starts to spike in a neighborhood. People don't want to be there. That's going to drive home prices down. So, an example of how appreciation can affect your investment is, let's say the duplex from our first section, that let's say that was purchased for $300,000. Now, let's say that over 6-7 years they opened up some restaurants and shopping and became a very appealing place to live, and then 7 years later you decide you need that money for something else and you're going to sell your investment property, and you're able to sell it for $400,000. So in addition to whatever of your spread that you've been able to capture over those 7 years of owning that property, you now get the net benefit of that additional $100,000 of appreciation that is also going to be money in your pocket, in addition to the fact that the mortgage payments you've been paying over the 7 years, that using the money received from your tenants is paying down the actual principal of the property itself, which will be money that then you will also be able to benefit from. But you really want to try to target a place where you're going to see a lot of positive appreciation, and a bare minimum where you're not going to see depreciation. I think the easiest way to do that is that most home search sites these days, particularly I know they have it on Redfin, they have it on Zillow, where it will give you statistics on what the average home price has done over time. You might see that in the last 5 years prices have only gone up in this neighborhood. That's usually probably a pretty good sign that trend will probably continue. Now, if they've been flat to fluctuating down, that should be a warning sign that might be an area you might want to think twice about. Not that you go to sell that same duplex from our example that you bought for $300,000, and then you can only get $250,000 for it down the road, and you might even owe the bank more than that, and that would be a negative cash flow situation you wouldn't want to get yourself into. So certainly consider trying to target neighborhoods with positive appreciation, and make sure that's part of what you're looking at when considering purchasing a rental home. So the second piece of this section is the taxes piece. We talked a little bit about taxes when determining what our spread is. Rental income minus your mortgage, taxes, and insurance. Taxes is a piece of that. We know it right up front. They should be able to tell you what the monthly tax rate is, before you even decide to purchase the home. But the one thing that will happen is taxes will change, right? The amount of your tax bill inherently will change, and almost always it's going to go up. More often than not, even if the tax rate doesn't change as far as what percent taxes it's a percent of what the estimated value of your home is. So in general, you bought it in a good neighborhood because of the appreciation aspect we just talked about. The offset to that in the short term is that your taxes will go up every time that they reassess the value of that home. So I'm not saying that you need to be concerned about buying a home where over time taxes are going to go up. That's just going to happen. It's going to be a slight offset to the positive you'll get from a positive appreciation. But you should at least understand in the short term what impact it might have on your spread. So most of the taxes that you pay on property taxes is actually state driven. So you'd have to understand state by state, one, what your tax rate is, but then two, more importantly, how often that they reappraise homes to see their value. So for example, in Illinois, they appraise homes, that's where we live and where our rental properties are. They reappraise homes every 3 years. So what that means is someone literally comes out to your house, looks at it, compares it to sale prices from other homes in the neighborhood going back over the past year, and they decide this is what this house is worth, and we'll take our taxes based on that. Now, on the north side of Chicago, where one of our rental properties is located, homes have been appreciating very quickly. The value of homes on the north side have been going up a lot over the last couple of years. The good side is the appreciation when we eventually go to sell the house, but knowing that we're not going to be doing that anytime soon. The bad side is on our most recent appraisal, which happened just this past year, that goes into effect on tax bills this year, our tax portion of our bank payment or our escrow literally went up over $300 a month. Like that, not a year, but a month. I mean, that is a baffling number to me. So if that was the example of the duplex that we've been using, where we had $2,000 a month of rental income, $1,600 a month on our costs of mortgage, insurance, and taxes, that $1,600 is now $1,900, and all of a sudden your $400 spread's gone down 75% to $100. You ideally don't want to be in that situation, or you at least need to know it's coming or try to budget for it. And in our example, we had, seeing the appreciation when we had bought this house, we knew we'd expect increasing tax bills over the year, but we also expect that, right, you can get that money back. The theory should be that if the value of the homes in that area are going up so much because people don't live there, the ability to charge more for rent should as well. You just have to understand that you might not get it all back in one chunk, right? And you probably at least have to wait till the next lease before you're going to be able to raise rent if it is justified. So certainly what I would say on the appreciation piece, look at Zillow, look at Redfin, apps like that would be able to tell you what appreciation neighbors are doing. And on the taxes side, understand when the next appraisals would be and what the current tax rates are so that you can factor that into your home buying decision.